Hey, everybody, welcome to Cigars and Syndications. We are passionate about cigars and we love our real estate. And the objective of this podcast is basically to teach you about cigars and about syndications, which is basically real estate and real estate investing. Uh, I'm here with my co host, Robbie Rogers, and today we are smoking a Rocky Patel number 6. What do you think about the cigar, Robbie?
Well, yeah, I really like it so far. It started off a little peppery, and but after a few puffs, it really started to mellow out and get creamy. So far, so good. I'm really enjoying it. It's again, it's the Rocky Patel number 6. It's all Honduran binder, wrapper, and filler, and really enjoying the smoke so far.
So I've never had this cigar before. This is the first time I'm smoking it. And when I initially lit it, I thought it was kind of bitter. It was a little harsh. But after a few puffs, it started to get a little more mellow. I'm enjoying the draw, nice peppery taste. It's getting a little creamier. And as we get along and go along in the podcast, we will update our viewers on what we think.
So today we're going to talk about speculation versus investing. And Jay, do you have any good stories or anything you'd like to share today?
Yeah, Robbie. So a lot of people ask me this question, right? How do I know if I'm investing or if I'm speculating? And there's a lot of different definitions of what investing is versus speculating. Um, One of the definitions is the one that I like to follow, which is the Benjamin Graham school of thought, which is what Warren Buffett also follows. And in Warren Buffett's mind, if you purchase an investment that is below its market value, which he calls the intrinsic value, then it's investing um, because you are walking into an investment or you are walking into an asset class already with money, already with equity
Okay, so you're looking for an equity position right away.
right away. And he has a very strict definition. He's a very methodical investor. And if he doesn't get his strict definition, he's not going to invest. But there are other definitions of investing versus speculating. And, we'll go through some of those different scenarios and what might constitute speculating and what might constitute investing. And, we're not saying one is worse than the other. But what we're saying is if you're going to be speculating, don't assume that that's investing. Don't disguise it as investing.
So there's no hard line. It's a personal investing and speculating. Um, there's no hard fast rule.
Absolutely. So you could take a stock and you can speculate on it just by buying options or throwing darts at a board or this whole debacle that happened with the AMC stocks and the GameStop stocks, which, everybody on Reddit was buying them. They were all speculating because they were not looking at the actual underlying asset. Those companies were not producing cash. It was just a whim of some of the people who were like, you know what, I like GameStop and I don't want somebody to short the stock and take the company into bankruptcy. So we're just going to start buying it.
It sounds like some investing that I did with crypto.
But see, with crypto, people made money too. So it's not like you can't make money in speculating, right? So let me break it down a little bit. When I was in college, I would purchase T-shirts and sweatshirts and sweatpants from a friend of my dad's who was printing them. Now he would print these apparel items with different logos, like the Bulls logo or the Bears logo up in Chicago. And I don't know if they were perfectly legal, but he did print them. And what I would do is I would go buy those sweatshirts and T-shirts from him, and then I would go to college and I would sell them and I would make a profit in between. That is investing. So basically, I knew the market, I knew the demand in the market. I would take orders from people who wanted those and sizes that they want. I would tell them what price they would be paying because I knew what my price was going to be. Then I would go buy, purchase the apparel items and hand them over and collect money. So I studied the market. I knew what my cost was going to be. I knew what my profit was going to be going into this deal. That would, in my definition, that is totally investing.
So maybe a little bit more due diligence, maybe a little bit more control pushes speculation and investing. Maybe that pushes it more to the investing side.
Absolutely. And so I did a speculation deal just like that too. Uh, somebody had told me that currency is the way to go, and I'm in my 20s at this time, right? Currency contracts are the way to go. So I had $5,000. I invested into a currency contract. I had no idea if that was going to go up or down. I had no idea if I was going to make money on it or lose money on it. I was basically just following somebody else's advice without knowing what I was getting into, without any due diligence, without any understanding of risk involved. And I went and bought this contract. And after a lot of sleepless nights of me losing money on that contract and me checking the currency prices on a daily basis, going, oh my God, I'm losing money. This is the only $5,000 I have. I'm losing money. I'm losing money. Finally, it turned around and I made money on the deal. But that was pure luck. It had nothing to do with a skill set or me or any kind of an educated guess as to whether this is going to go up or down.
Would you expect your return to be higher on a speculative venture versus an investment?
Absolutely, because it's a riskier deal, right? When you're getting into, for example, Bitcoin, right? Why is Bitcoin pure speculation? Because there's no underlying value. And a lot of people will disagree with me and they'll say, oh no, Bitcoin does have underlying value. But the reality of it is it's not backed by anything, right? So the US dollar, for example, is backed by all the goods and services, the GDP that is produced in the United States. It's backed by the United States government collecting income taxes. But Bitcoin is not backed by anything. It's just, how does it go up and down? Well, Elon Musk decides to purchase Bitcoin and then tweets, hey, Tesla's going to start accepting Bitcoin now. All of a sudden, the price shoots up. Then he dumps it and he says, Tesla will no longer accept Bitcoin because it's a risk. Now the price goes down.
So a lot more of supply and demand in crypto.
Exactly. There's not an underlying value to it. It's just based on emotion, right? It's based on people thinking, I think it's going to go up versus I think it's going to go down. And stock can be the same way, right? I think it's going to go up versus I think it's going to go down. Or, somebody gave me a tip that this stock is about to shoot up. Somebody created a WhatsApp group that they pushed me into, and they're just like, I am this great stock trader and I've been working at this big firm for, 10 years and I've got this great tip and everybody should buy it. And he didn't really provide any kind of realistic information as to why we should buy it. I think we should buy it, and people bought it and people lost money, lots of money. So stocks can also be speculative, but when you start studying the underlying asset of the stock, right? What is the PE ratio? What is their growth potential? Are they announcing a new product? You know, as Buffett always says, right? The market can get crazy. The market can shoot up a stock or shoot down a stock based on no reason whatsoever other than emotion. But if you can figure out the real value of that stock and the market becomes schizophrenic and drops the value of that stock, you go ahead and buy it because it'll always come back up to its real value.
How would you take this speculation versus investment and apply it to, what we're here to talk about today is real estate?
Well, in real estate, you can have the same issues. You can buy an asset, and I know people who do this, right? They buy a single family house, or they buy even a multifamily property, hoping or thinking that I think the value of the single family house is going to go up in a year or 2 years, and then I will sell it. The problem is they're basing that on hope, and hope is not a strategy; it's speculation, right? So when I bought my single family homes that I put out for rental, I would look at what the market value of that house is going to be once it's repaired, which is known as the ARV, the after repair value. Then I would subtract the amount of renovations I would have to do. Then I would subtract another 20%. And then I would give that offer to the seller. And if they didn't accept that offer, I'd walk away from the deal. So all of my houses would have a minimum of 20% of equity when I walked into the deal. Otherwise, you walk away.
So Warren Buffett principle.
Warren Buffett principle, and it worked well for me. I walked in with 20% deal, with 20% equity into all my deals. And then just by fluke, supply and demand, the market went up much higher than what I expected. But it didn't drop because I had that 20% margin. And incidentally, there's a reason why banks, when you go to buy your house, banks want a 20% down payment in order to avoid the PMI, which is the mortgage insurance. That reason is the same because when markets drop, they don't normally drop more than 20%. There will be some flukes like 2008 where everybody was just dropping, they were dropping their houses. But that was also a big fluke because people bought at um, very high values and very weird loan instruments, the variable loan instruments and things like that. But the base rule for banks to have a 20% down payment to avoid PMI is for that reason, because historically, other than a fluke year, houses don't drop more than 20% in value, and that always gives a bank their cushion, their margin, so that they don't have to call the note or they don't have to come to you and say, all right, you need to add more money to the loan because now your house, the actual asset is worth less than the loan.
Well, I hate to switch gears on you, but I'm going to talk about this number six a little bit more. It really, it started off really peppery, and the draw might have been a little stiff. It really smoothing out, really getting creamy. I'm getting some hints of coffee now, and maybe just a little sweetness. It's a really enjoyable smoke so far. What do you think?
I am liking this cigar right now, and I honestly I have not smoked a lot of Rocky Patel, but this is a very good cigar. I would put it on my list of cigars that I would smoke on a normal average basis frequently. But yeah, I'm liking the cigar. It's very mellow. It's creamy. A little bit of pepper. The pepper is not as much to me, but I am getting my coffee taste, which is, I love the coffee flavor.
I really like the Warren Buffett investment strategy, and moving forward in an investment, whether it be speculative or investing. I really think that going forward in an equity position is always a wise move. But honestly, there's a little bit of speculation in any investing, and I think that you'd really owe it to yourself to do the due diligence and understand as much as you can when investing, whether it be speculative or investing.
Yeah, so there is some amount of speculation in every investing, but the question you need to ask is, do I understand the risk? Uh, is that risk acceptable to me? And what is the mechanism for making a profit, right? If the mechanism for making a profit, and again, I'm not saying don't speculate. You can make money in speculation as well, but we don't want people to think you're investing when you're speculating, right? So if the mechanism for making a profit is the thread on Reddit is saying so, or my buddy told me at the car wash that this is a good stock to get into, and you don't really understand what that mechanism is, then it's speculation, and you should treat it as such. And I have some speculative products in my portfolio, but it's not a large portion of my portfolio. It's a small portion. So if you lose the money, you lose the money, and you have to be ready to lose the money.
Well, I've done a little speculating, and with Bitcoin, even with properties, buying properties and anticipation of growth moving out towards the properties. And so, yeah, there is definitely speculation in everything, and risk. And always looking for a little bit higher risk, the more speculative.
So the other thing I wanted to mention, Robbie, is that with speculating, as I mentioned before, that it can be a part of your portfolio. You should be with that portion of your portfolio. You should be okay to lose that money because it's a speculative deal. If you read about all of these people who invested in Bitcoin or people who invested in, AMC stock when it was hot, or GameStop. I mean, there are people who put in their life savings into one deal because they thought this was going to make them millionaires, you know, and then they lost that money. I actually know of somebody who sent me a link on a GoFundMe account. He basically said, I invested my college tuition in GameStop and I lost all my money. Please help me out. I mean,
I think we just lost a viewer.
yeah, I think so too.
How do you feel about actual syndication and real estate from the standpoint of speculation?
So, in a syndication deal where you're talking about a large deal, right? A large multifamily or a large self storage deal where you have limited partners and general partners. Limited partners and general partners should both understand why this deal makes money, what the mechanism is, and quite frankly, what is the track record of the general partner, as well as how did the general partner underwrite the deal. So, for example, we were talking to a friend of ours a few days back while we were having cigars with him, and I asked him, how did people justify buying multifamily in Phoenix at $350,000 to $400,000 a door? And his answer was, well, they were writing 20% increases in rent every year. Now, that does not make sense to me. I can understand the demand is high and the supply is low, and so you will have large increases in rent for maybe 2 years or 3 years, maybe even 4 years. But 20% a year for an ongoing basis, people only make so much income. And they can only afford so much of a rent hike before they'll be like, I can't afford this anymore. So when people, that's speculating, right? What are you basing the fact that there will be 20% rent increases every year for the next 10 years?
Yeah, how do you do that? I mean, you can't, in my mind, logically do that and expect it to work.
And that's exactly it, right? When you see that people are coming up with numbers of making money and increasing, and it doesn't sound right, you know, that whole old adage of if it sounds too good to be true, it probably is. You know, somebody's coming in saying, well, I can make you 40 and 50% returns. Well, how are you going to get that? And he might be right. They may be right. They may be able to make those returns. But if the basis, if the calculations of making those returns is kind of far-fetched, then it might be speculation. And if it's within norms, so when we underwrite our deals, we write 3% property rental increases. So we stay conservative. Now, if we get more, if we get a 5% or if we get an 8%, that's great. We'll make money. The investors will make money. But that's not how we sell the deal. We don't sell the deal on 20% rent increases every year. That's pure speculation because you have nothing to base this on. You don't have any kind of background information that shows that historically it's been going up. You know, if it's been going up in a market for 20% a year for 10 years, absolutely write it. But most markets, none of the markets that I know of will do that. Maybe for the last 2 or 3 years, but not for 10 years.
Do you think that the actual value of the property itself can reduce the amount of speculation?
Absolutely. Just like Warren Buffett says, right? If you buy the if you buy below intrinsic value, so if you're purchasing an existing multifamily and you're in a multifamily deal, and you know the general partners can explain to you that our rents are all undervalued. We're, you know, here, look at the 5 other multifamily projects near our project that we're buying. Our rents are 20% below value. Yes, we need to put in, you know, $3-4 million to renovate it, but once we get the renovation done and we can increase the rents, the value will go up. But that's no different from when I bought my houses, right? You take what the value is going to be after the repairs are done, after the renovations are done, based on the increased rents. You subtract the renovation cost, and then you subtract a discount, and that's a perfectly legitimate example. Now, if you go in and say, well, you know, our rents are at market value, but because of the way the economy is going, we think the rents are going to go up another 20% next year just because there's so much demand. To me, that sounds like speculation.
It really sounds like, as a limited partner in this syndication, do your due diligence, pick your partners well, understand the properties and locations that you're investing in, and you can limit some of your exposure.
Yeah, and if you want to get into a speculative deal, just understand that it's a speculative deal. And I know I was reading the Wall Street Journal one year, and they did this analysis where they basically randomly picked stock and they threw darts. They put it on a dartboard and they threw darts at it, and they bought those stocks, and they had a pretty good return, but they cannot consistently make that return over and over again, right? So the people who made money in Bitcoin can't consistently do it over and over again. When you're investing and you're understanding the risk and you're buying it at a discount, you will consistently make money.
Well, that pretty much wraps it up for us today. I hope everybody enjoyed our show and learned a little bit about speculation versus investing. Um, we're wrapping up this cigar here. It's really good smoke. Still continuing to be pretty mellow. I would say it's probably on the milder side, but a really enjoyable smoke. This Rocky Patel #6 is spot on.
Yeah, I am actually liking this cigar. It is a little bit lighter than what I'm used to smoking, but it's mellowed out. It's creamy. Um, we hope you enjoyed today's show. We have a lot of resources available at www.albanyparkcapital.com. Just hit the resources tab, and there's a lot of articles available. The other thing that I wanted to mention is that for people who are interested in learning more about speculation versus investing, I highly recommend reading Benjamin Graham's book. It's called The Intelligent Investor. And that's where I kind of started learning about what the differences are between speculation and investing. And that book taught me a lot. He was Warren Buffett's teacher, and he was the father of modern intrinsic value or modern investing, basically.
Thanks for joining us today. Check us out on all our social media platforms, and look forward to seeing you on the next episode.
Thank you.